Ladies and gentlemen, and welcome to the PDS Limited Q4 and FY23 conference call. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Nikhil Chaudhary from Nuvama Wealth. Thank you, and over to you, sir.
Thank you. Good afternoon, everyone. On behalf of Nuvama, I welcome you all to PDS Limited Q4 FY23 earnings call. We have with us today Mr. Palak Seth, Executive Vice Chairman, PDS Limited, Mr. Sanjay Jain, Group CEO, Mr. Rahul Ahuja, Group CFO, and Ms. Reena Joseph, Head Corporate Finance, M&A, and Chief IR. Before I hand over the floor to Palak, I would like to highlight that the safe harbor statement on the second slide of analyst presentation is assumed to be read and understood. With this, Palak, over to you. Thank you.
Hi, good morning, good afternoon, everyone. A warm welcome to you all to our fourth quarter and full year 2023 earnings call. The investor update and the financial results are available on the company website and the stock exchanges. I would like to draw to your attention that the discussion today may have forward-looking statements which are subject to certain risks, uncertainties, and other factors that could cause actual results to differ from those contemplated by the relevant forward-looking statements. The 2023 financial year has been an intriguing year for us. In the first 2 quarters, we have achieved high growth, while during the second half, we've witnessed some slowdown. The impact of the macroeconomic and geopolitical factors had a bearing on our operations. We have witnessed some customer pushbacks due to lower demand and high level of inventory with brands and retailers. The impact of these factors is expected to continue in the first half of the financial year 2024. However, as the saying goes, every cloud has a silver lining. Similarly, for us during these times of muted demand, we are also witnessing huge amounts of new opportunities, and the pipeline of opportunities is better now than we've ever seen in the last 25 years of the company's formation. As our customers continue to focus on their front-end operations, customer acquisition, and visual merchandising, among others, they seek credible partners such as PDS to manage their sourcing operations. The credibility here refers to the ability to provide global sourcing solutions with full governance standards, with financial stability, and almost a debt-free balance sheet. In order to tap into these opportunities, 18 months back, we launched Sourcing as a Service, which has witnessed good traction with PDS signing contracts with the potential to handle merchandise value over $1 billion. As part of the ramp-up, we should be clocking closer to 50% levels of the merchandise value during the current year. We are also pleased to share that John Lewis has entered into agreement with PDS subsidiary in Turkey called Spring Near East to help us manage their sourcing. John Lewis owns and operates department stores, supermarkets, and convenience stores in the UK. The company conducts its business operation under John Lewis and Waitrose and has reported top line of 10 billion, with 5 billion derived from John Lewis alone. Also, I'm happy to just announce that just before this call, PDS has got into a strategic partnership with a large German retailer called Gary Weber. PDS will be taking over their sourcing operations in Asia through its subsidiary Techno Design in Germany and managing that business. This business also has a potential sourcing volume of over $100 million, which will be added to our top line in the next couple of years. The traction of our SaaS model enables us to curate more customized solutions. We have also recently signed a strategic partnership with one of US's largest IT companies called Authentic Brand Group, which has over $30 billion retail sales. And their acquisition of Ted Baker in UK, PDS has become a strategic partner to them, managing Tech Design Group, which will run the Ted Baker head office, plus also wholesale business, both in UK and Europe. The focus is on driving business through long-term strategic partnership, which significantly enhances medium to long-term visibility into the business and drives the annuity stream of revenue for PDS. Further, this is enabling us to transition from low-margin transactional orders and focus on value-accretive businesses, driving higher margins along with better return ratios and long-term nature of contracts. It is interesting to note, globally, there is no single platform in the fashion industry like PDS, because of which we are getting immense opportunities if a retailer has to do strategy, PDS is emerging as a point of choice for them to engage and discuss strategically their plan. As a company, we're not interested in selling to retailers, but become part of their strategy. So that is opening huge amount of opportunities for us on the whole sourcing business, where retailers need to restructure their operations and let specialist players handle their back end. Also, I'm pleased to mention that our manufacturing business reported its first year of profitability. We are focusing on driving our profitability journey in this segment. During the year, we expanded our capabilities across our manufacturing vertical. Our Bangladesh facility launched a washing plant, which was funded by Good Fashion Fund. Good Fashion Fund is one of its kind impact fund initiated by the Lourdes Foundation, founded by CNA family. Aim to drive systematic challenges in the textile and apparel industry by financing the implementation of state-of-art and disruptive technologies, innovation, and delivering good fashion practices. Further, we have also launched a centralized cutting plant in Sri Lanka. These investments are key steps forward in enhancing the PDS manufacturing vertical capabilities to state-of-art machinery and digitized processes. PDS is also now pursuing expanding its manufacturing footprint in new geographies like Egypt and India. Egypt is duty-free to the US like 12-day sailing. Plus, India also is seeing increased demand, so we are considering to make potential acquisition in India to enhance our own manufacturing footprint. With an aim to expand its supply chain capabilities in the fashion value chain, PDS has also announced acquisition of a logistics company called Transport Partners Limited. They are based in Bangladesh and are already working with some large retailers and brands. So PDS, being a platform company, not only is offering its customers today design-led sourcing, but also running their offices, complete brand management, manufacturing options, as well as ability to handle their logistics. So this all factors of being a platform is increasing our stickiness with our customers who are looking to us more and more as solution providers. And as I had mentioned earlier, globally, we are probably one of the only companies who can have strategic discussion with large retailers who are Fortune 100, S&P 500, and DAX 30 companies and be aligned to their strategy and their future roadmap. We continue to focus on building a robust platform where our businesses and verticals can thrive and grow. As a platform, we are working effortlessly to strengthen our digital capabilities initiatives and to drive process improvements and efficiencies. These initiatives are driven by our group CIO, Saurabh Saxena, who is ex-IBM. Further, we have augmented our teams by hiring experts in fabric and trim procurement, which will enable us to drive more procurement synergy. We are pleased to share during the year, PDS India and Sri Lankan subsidiary are certified also as Great Place to Work. It gives me also great pleasure to announce that Mr. B.G. Srinivas has come to PDS board as a board of directors. Mr. Srinivas is a well-known and respected member of India Incorporated with over 30 years of experience in the information technology sector and was previously the president and whole-time director of Infosys Limited. With his global expertise in strategy, operations, finance, especially his experience in the technology sector, make Mr. B.G. a vital addition to our board. PDS is going towards a full 100% compliance journey, and having Mr. B.G. guiding us in this process is also a great testament of our future plans as a company. As a global platform, our outlook for the long term is strong and robust. We are very much geared to continue to aspire to achieve more than $2.5 billion of top line in the next couple of years, along with a gradual increase in profitability. However, we do see some headwinds in the next few quarters of 2024. Having said that, we are focusing on building a pipeline of curated business opportunities, which I had mentioned earlier, with existing and new customers, which will drive our growth and profitability in the years to come. Thank you very much for joining our call today. I would like to hand over the call to Rahul Ahuja, our Group CFO. Thank you very much.
Good afternoon, everyone. We are pleased to share that PDS has delivered a 20% growth in the financial year ended 31st March 2023 and reported a top line of 10,577 crores. We reported gross margins of 16.7%, an expansion of 53 basis points compared to the last year. Our EBITDA grew by 40% from 327 crores in FY22 to 459 crores in FY23. EBITDA margins also expanded by 64 basis points to 4.3% in FY23. EBIT during the year increased by 25% compared to last year, which includes 36 crores gain from our sale of our real estate property in Milton Keynes in FY23 and around 41 crore of gain from the sale of real estate investment property in the UK in FY22. Our profit before tax has increased by 15%, which included the impact of the increase in interest cost during the year. Our total gross debt decreased from rupees 623 crore last year to 601 crore this year. However, the interest cost increased from 33 crores in FY22 to 74 crore in FY23. This is mainly attributable to the increase in borrowing costs, with SOFR LIBOR increasing from 0.08% in March 22 to 4.16% in March 2023. We continue to be in a comfortable position with net debt being negative. Our sourcing segment, which accounts for 96% of our top line, has clocked 19% growth compared to the previous year, with a top line of 10,105 crores. Our sourcing business reported an EBIT of 366 crore, which is an 18% growth compared to FY22, and a return on capital employed of 48%. The new verticals contributed 614 crores to the top line compared to 321 crores in FY22. Given their gestation phase, these businesses had a PBT loss of 51 crores. As these businesses grow and achieve size and scale, they will contribute to the bottom line of the company. Our manufacturing segment reported a growth of 28% with a top line of 703 crores versus 547 crores in FY22. This segment achieved its first full year of profitability journey with a PAT margin of 2.6% in FY23 versus a loss of around 3.6% in last year. Talking about our balance sheet, our net debt was negative with net cash of 128 crores versus 41 crores reported last year. Notwithstanding the 20% growth, we continue to operate with negative 2 days of net working capital days, and we would focus on staying on this journey. However, our new ventures into brand management might expand the working capital requirements temporarily going forward. We will focus on driving working capital optimization as the business comes into our fold. The company continues the growth and profitability journey and delivered 44% return on capital employed and return on equity of 29% in FY23. We would now be happy to answer questions that you might have.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. We have our first question from the line of Vishal Prasad from VP Capital. Please go ahead.
Hi, good afternoon. Samit, I'm trying to understand how sourcing as a service is different from design as a service. If you could help me understand that, that would be great.
Yeah. So how sourcing as a service is different from design-led sourcing, right?
Right.
Yeah. So basically, design-led sourcing is a vendor model where we are working with retailers providing a full solution of design development and sourcing from third-party factories. In design-led sourcing, there's no long-term contract. Every 6 months, we are presenting new product. There's a strategic relationship with the customers, but still we need to start business every 6 months on getting new revenue streams with them. There's a higher margin business because obviously then, it's order to order, and then we are basically giving them the design development, and then we are doing the business with the customers. Where sourcing as a service is totally different because it is actually running the retailer's offices for them, where the entire business of the retailer in a particular market is run through that office. So we did a deal with Heinz and then also with Asda, and today we announced with Gary Weber as well, another German brand, where retailers today don't want to have the headache and the ESG governance issues of having offices around Asia in many of these emerging market countries. So PDS is being seen as a platform which gives high governance standards and our ability to attract the best talent and open offices for the retailer in these markets where everything the retailer sources from that particular geography will come to the PDS office, very often under joint branding between the retailer and PDS. So for example, with Asda, they were running their own offices earlier. With Walmart, they decided to not continue with Walmart relationship, and PDS came in as one of the options. So the entire $500 million business of the largest supermarket between home and general merchandise and clothing, PDS took over the existing teams in between China, Bangladesh, India, and other geographies wherever they have presence. And those teams became part of the PDS platform, servicing them on an open, transparent, cost-plus basis model. So again, just differentiating design and sourcing is order to order, season by season, starting again, but sourcing a service is actually representing the retailer in a market. The entire business goes through that operation through the offices we set up with the customer. So today, retailers, either they want to enter new geographies where they don't have offices, PDS is becoming their office instead of them opening themselves, or where they're currently already running operations, they don't want the headache of having teams, across Asia to be managing by themselves because their focus is now more on the retail and customer side. PDS is taking over retailer operations in these parts of the world and running it for them. So margin structure is different and the volume of business quantum is different in both these options. Have I been able to answer your question?
Yeah, so to add to that, is it possible for you to elaborate on our roles and responsibilities in a sourcing as a service contract? What things we generally do in that?
So sourcing as a service, basically we start from, so the design comes from the customer in this part of the business. So customers send their tech back. Our team on the ground in countries like Asia, in Bangladesh, India, wherever we have these offices, we will get the tech back, then we will source the best, most compliant, cost-effective vendor base. We'll get into price negotiation, product development, quality control, and order follow-up merchandising. So our role is basically not design, but basically managing the office for the customer in that part of the world, in these functions.
So is it possible?
Sometimes we get involved in financing, other times we will not. Like Mr. Jain and I just also mentioned, we have signed over $1 billion of sourcing as a service contract. We are not going to be invoicing $1 billion on our top line. So our income is going to be the service fee we are going to be taking for this business, and the profit is a percentage of the service fee. So sourcing a service model has, infinite return on capital employed because our capital employed is not coming as much, right? We are just running the overhead of the office. The downside is low because the retailers are also paying the cost of the operation on a monthly basis, and our profitability is clear. So for example, on $1 billion, I'm just giving some examples, we charge a 4% management fee. So our gross revenue is $40 million, and our profit is on a cost-plus model. So we say, for example, we're going to be running on a 2% profit of this business. So 40 million is our top line which will be added, and 20 million will be the bottom line that will be added in this vertical. The gross merchandise value we will handle is $1 billion in that case. But we're not invoicing $1 billion, we're invoicing only the gross margin, and the profit is a percentage of the gross margin. So there's no capital employed in this basis, but gives us immense power in the markets we operate because then PDS is, representing the retailers, some of the biggest factories in Asia. So our vendor base in this model are some of the biggest manufacturers, even in India or Bangladesh, or other geographies we operate, who are taking orders from these offices, which is run by PDS.
So is it possible for us to get sourcing as a service as well as design as a service? So,
Yes.
It is possible.
The same retailer, there are various cases because, retailer has certain part of the business managed through third-party design and certain part of the business which is sourced directly from them with their own design services. So normally I would say 60% is sourcing as they do their own design and source to their own offices now, which PDS is taking over. And 40% is they look at third-party vendor for design and control. So it's not uncommon that with the same retailer, when we start offering them a menu of services, we look at PDS for both options. So it's quite possible. PDS today is a product company. We are offering 4 products to our customers. One is our own manufacturing, which is small but is important to keep to make sure that we have the credibility in our industry and also onboard certain customers who only work with manufacturing teams. Second is a vendor model, right, which is basically design-led sourcing, which we are offering full complete design services. Third is running the retailers' offices, right, and fourth is brand management. So with the same customer, we are offering them 4 menu of services, and then they're picking and choosing what they want. But there is a role for each 4 of them within the same retailer to be able to work. And that's how our penetration and stickiness with the retailers is increasing, because they see us as a solution provider rather than just a factory in Meghalaya Asia trying to sell into them. Which is, I feel there's no future in that business in our industry.
So let's take the example that.
So this is Sanjay here. Just to add to what Palak said, with one UK-based customer, our design-led sourcing annual business is about 800 crore plus. The sourcing as a service contract that we have signed is approximately 3,200 crore of gross merchandise value. This is 1 and 2. And very recently, from the same customer, we also got a contract for the home category that we are heading to. And that contract would give us an annual potential of about 1,000 crore worth of home merchandise being handled for the same customer. So with one customer, 3 kind of revenue streams are currently already there in terms of contract we have signed. Sorry, Palak.
Yeah, based on strategic discussion. So when we talk to our customers today, we have a board level discussion, and they all want to discuss what are their pain points, what is the next 5-year strategy, and how PDS can be a solution provider to their pain points in the strategy. So we are not interested to sell garments to anyone or consumer goods. We are only interested to be part of the strategy and align with them to provide solutions.
Yeah, that's great. And one last question, sir.
I request you to join
yeah,
us.
sure.
Thank you, sir.
Sure.
Thank you. We have our next question from the line of Keshav from Raksan Investors. Please go ahead.
Hi, sir, just to understand demand side risks a bit better. So in times when the demand goes down, the garmenters typically get squeezed, and there could be some sourcing shift from country to country. So if, say, the demand sees a sizable reduction, and if retailers face difficulty passing on the costs, then in the entire supply chain, right from fabric to garmenters to us who are handling the merchandise, do we all have to take some price readjustments, or we are relatively insulated?
I would say, we are relatively insulated, but at the same time, if we take a strategic view that, we need to support our customer to continue gaining market share, that's a strategic view we will take if we have to take. For example, if a customer is doing $50 million, but they need support and they think they're willing to grow with us to $150, but, we need to help and partner with them on the margin challenge. So we are going to take a, not a quarterly view, but a 6 to 12 month view and partner with them to achieve their objectives. So, today it's important to partner with people, understand their strategy, raw material prices go up and down, and making sure that, we are collaborative in our working, but at the same time protecting our own interests.
Understood.
But, again, being an asset-light model, we can pass on a lot of the costs. We can, if we are getting squeezed, we can squeeze the yarn, fabric, trim, manufacturing partners. So everyone, at the end of the day, we are not sitting on huge open capacities of hundreds and thousands of machines to feed, right? So we are able to then pass that to the factories, which have huge capacities to feed. So, they will also want to get the business. So PDS is seen as a platform to many manufacturers in Asia to make sure that capacities don't go idle and they get feeding from our company. So they will also have you on that.
So secondly, so we have had some exclusive and non-exclusive relationships for sourcing out of Turkey. So what's been the impact? What's been our response? And what's the value at risk there?
So Turkey, one of the markets, now the election is just happening, I think, this week. So the thing is that many of the emerging countries like, Sri Lanka, Egypt, India, Pakistan, so wherever the rupee dollar, trend is there, normally the dollar is becoming stronger and these emerging market countries are becoming weaker. So even there's huge inflation coming, but in export sector, because of devaluation, most of it is getting nullified. So that is one advantage we have in being in the export business. Turkey as a country is a little bit under pressure right now because of geopolitical situation and the earthquake that happened. But the thing is, many small, medium-sized businesses disappear. It's only consolidation and survival of the fittest. So PDS is seen as a safe pair of hands with high governance standards, financial stability, ability to attract the best people. So retailers continue to partner with us in that journey. So rather than them trying to work with other small, medium-sized companies, PDS has now gained enough critical mass and has got enough, goodwill in the industry that we are seen as the company of choice for them to partner, even if the macroeconomic situation is getting tougher.
Right, sir. And sir, lastly, what would be the reason for a decline in manufacturing margin quarter on quarter?
Sanjay, you want to take that, please?
Yeah. I think this is just barely seasonal in terms of the mix that we have had for the particular quarter. There are no permanent inferences to be drawn. For a year-over-year, we see the gross margin trajectory keep improving. So to specifically answer your question, it's just a mix that we had for a particular quarter and no other specific reason. That's one. And from our own effort side, given the fact that we clocked in 1.4 billion top line in the last 12 months, and I've got $1 billion plus of sourcing as a service order, plus a recently signed Ted Baker Gary deal. As a group, the amount of fabric and amount of trims that we are handling should give us humongous purchasing, efficiencies. They should also start getting reflected in our gross margins of manufacturing as well. So I think it's just a mix for a particular thing, nothing otherwise.
Okay. Thank you, sir. That's all from me. Thank you.
Thank you. We have a next question from the line of Mohammed Patel from Care Portfolio Managers. Please go ahead.
Hi, sir. How's the demand scenario in the current quarter as compared to last two quarters?
Current quarter means lessons, please.
Yeah. So I'll take that, Palak. So as we mentioned in the last call, as Mr. Palak said, touched upon, that the global situation has a bearing on the last quarter and the next two quarters. But we see signals of on-ground activity increasing now. If you talk about the locations like Bangladesh and Sri Lanka and India or Turkey, from where we source in terms of manufacturing, the buyers are now coming into active discussion. So therefore, for the spring-summer collections of 24, February, March, typically the order gets placed by September, October of 23. So therefore, while the immediate quarter and the next quarter are a bit soft, impacted by the global situations, but the signals are coming in good that the second half of the year should be considerably better than the first half. And this is commenting on or reflecting on the continued design-led sourcing business. But as Mr. Seth earlier touched upon, as we keep signing into more long-term annuity-based contracts, then our longevity of revenue would keep improving. But on as-is basis, we see traction improving in the second half to be considerably better.
Okay. Consolidated EBITDA margins are better, but the segment margins are both down YoY and QoQ in sourcing segment. So can you explain that?
Yeah, I think one reason is that for our new verticals, which as our CFO Rahul Ahuja mentioned, for the entire year we have incurred 51 crore of loss, which is akin to an investment into the gestation phase. So the loss in the 9 months figure was 37, and in the quarter 4 alone it is about 14 crores because we are starting new verticals. So therefore, it's more an impact of the new verticals loss going up in quarter 4. But we anticipate during the current year PBT break-even during the new verticals. That's one of the reasons for any margins being softer sequentially in this quarter versus last year.
So you'll be doing PBT break-even in FY24 on the new ventures?
Yeah, I think two things there. One is For the verticals that we already have, which incur a 51 crore loss, we anticipate a break-even. But at the same time, selectively, carefully, we would keep committing to new verticals as well going forward. So that's the investment into growth. But to answer the question, we are targeting towards a PBT break-even in the current year.
Okay. Other income has also fallen YOY and QQ. So what are the specific reasons?
See, other income, in fact, the agency contracts, agency business, part of the revenue of ours is agency, and typically that doesn't go to the turnover. Any agency commission goes into the other income. So that's one thing that actually declined during this quarter. Plus, I think there were, for example, some of the scrap sales that we had as part of our inventory cleanup in the previous quarter of last year. That reduced as well. So these are some, and then there was a 3 crore profit on one of our venture tech investments as well in the period in quarter 4 last year. So there are some 2-3 reasons because of which you see a lower other income in this quarter. But any recurring kind of income, is well intact.
Okay. And also, if you can throw some light on the potential of the recent deals like Ted Baker, Gary Weber, what can be the GMV top line or bottom line potential, if you can just help us understand.
Yeah. So, Palak, I'll take that one.
Yes, please.
Yeah, I think for Ted Baker, there are two kind of revenue streams that would come to us. One is that as we are handling the global design, then the merchandise value that we would be handling under this, we would be having about $90 to $100 million worth. So there is a 10%, 90 to 100 million pounds, which means in terms of dollar, it is 1.2 times more. And we should get about 10% commission on that. And then there is wholesale, for which we are the chosen partner for Ted Baker. That has annual potential of 60 to 70 million pounds with anticipated 35% margin. So therefore, if I have to summarize the two revenue streams of Ted Baker, it's about $80 million, about $100 million annually, which means about 800 crore coming in from Ted Baker. It may take us 2-3 quarters to get to the full relevant potential. That's Ted Baker alone. In terms of Gary Weber, that's approximately $100 million of annual sourcing that we would be handling for customers. Here we are acting as a principal. So that's another 800 crores. So these put together is about 1,600. John Lewis is about circa $10 to $15 million that we would be handling, and we would getting an agency commission there as well. So these two contracts is about 1,600 crore. The $1 billion sourcing as a service that we already reported we signed up. We are aiming that we should be able to get to 50% levels. That means around 4,000 to 5,000 crore is what we would be handling. And on that, as Mr. Seth said, 4% will come to us. So 160 crore is my revenue. So to now add up everything, 800 crore plus of Ted Baker, 800 crore worth of Gary Weber's, and about 160 crore coming in as in terms of revenue to our books. That's about 16 to 1800 crore visibility on a per annum basis as we scale up the new contracts that we have signed, which is 15-16% more than the current annualized top line that we are having at present.
And Sanjay, we have 10 more in discussion.
Yeah.
Amount of opportunity PDS is getting now, we have not got in last 25 years of being existing. So, the company's been listed for since 2007 or 8. But the restructuring happening in the industry, the consolidation happening, there being no other global players strategically being able to engage with the retailers, having a platform model, offering various variety of services, many of services, is just immense opportunity that we are finding, for the mid to long term. So the short-term demand slowdown is honestly not of concern to us much. But yes, 6 months, there is going to be some softening in demand. But all these new things we are currently doing have not even been budgeted in our next financial year. Internal budget. It's going to have a very big impact, hopefully in the next couple of years.
I have one last question. So in one of the interviews, you said that FY24 you are expecting a single-digit growth in revenues. and we have a lot of deals that we have signed. So are you being conservative on that guidance?
I think we are trying to be, commit with you, prudent here, cautious here as well. Yes, we are very positive, very confident, feel good about the contracts we are signing and with the funnel of such contracts. But low single-digit growth is coming out of a bit of caution. So yes, we are a bit cautious and careful. We really hope that we should be able to do better, but that's where we stand as of now.
Thank you.
The testament in our industry is the support we get from our commercial banks. So the banking partner PDS has got is a very diversified portfolio of banking partners for working capital limits. We just onboarded DBS, Singapore, Hang Seng in Hong Kong, and a few others who are in the pipeline. I met them in Hong Kong recently, and their comment was that in the last 2 years, they've got many of the small, medium-sized apparel, fashion, consumer good accounts out of their portfolio. PDS is the only one they've added, and they have huge amount of appetite to grow with us. So consolidation not only happening in the retail, but also in the banking for support to the sector. So all these are, good factors that are supporting our build-up of the business, which are going to enable us to, capture more market share as the industry basically consolidates.
Thank you, sir.
Thank you. We have our next question from the line of Sarvesh Gupta from Maximal Capital. Please go ahead.
Good afternoon, sir. Sir, on the P&L, I had few questions. You alluded to, the profitability being lower this time because of the new sort of investments in the new verticals. But when I'm seeing your sort of the P&L, I'm not able to sort of reconcile that with a high increase in employee or the other expenses. It is more sort of linked with, our own revenues not growing as much.
Yeah, I think that it's a good observation. I think, as I said, one of the prime reasons is an extra 4 crore loss. But then there is a recurring cost at which, we run the entire enterprise. And typically in quarter 4, one derives much more revenue than the one we have achieved right now. It's flattish quarter as compared to the same quarter last year. So when you're expensing of the recurring cost, employee cost and other cost, the revenue base could have been much higher, And in a scenario wherein we would have a low belief in the future, fund would have gone into cost optimization, cost restructuring. But we believe it's a temporary phenomenon, and therefore the investment we have made into getting our designers, merchandisers, our compliance ESG professionals on board, we will remain put with that because of the thing that we mentioned, that is just a temporary blip for 1 or 2 quarters. So yes, your observation is smart that we are in a way expensing of the cost in a quarter wherein the revenue could have been more higher being a quarter 4.
And earlier we had alluded to doubling of our top line by FY27. So are we still on that path or we would want to change it given the market scenario?
I think we remain positive, confident on that path. Such fluctuations will keep happening. And what Palak mentioned, and what we've also touched upon in an investor release, that even the current tough environment is throwing up exciting opportunities, which is what we are converting into long-term contracts. So therefore, we remain positive about doubling up our turnover in a 5-year horizon from FY22 to FY27.
Understood. On your finance cost and other income, sir, we are, we have seen significantly low debt as such, in fact, we are net cash. But so how much is the non-interest linked finance cost in your finance cost line item? And what is your normalized sort of another income, excluding all these one-offs from the sale of properties, etc.?
Yeah, I think on the first one, I think what I can best answer at this stage is while the finance cost for the full year has gone up from 33 to 74, which is kind of a 40 crore increase. We've analyzed out of this 40 crore increase, 25% is attributable to an average gross debt increase this year versus last year. 25% is attributable to that, and 75%, as the CFO Rahul Oza mentioned, that the LIBOR or the SOFR base rate has gone from less than 0.5% to more than 4%. Why did we consciously allow the gross debt average utilization to go up by 25%? We felt that there is an opportunity to get an early payment discount from our vendors. And in fact, if you see year over year, there was 50 basis point improvement in the gross margin as well. It's a coincidence that, when we were doing a mathematical analysis, that nearly 25% of this gross margin increase is coming in because I got an EPD. So my early payment discount is up 30%. My gross utilization is up 25%. So therefore, if we all believe that the interest rates are peaking out maybe now or in the next 3 months and they should head southwards, then 75% of my interest cost should get favorably impacted. That is one. And the second factor, which we have touched upon in the previous 1 or 2 quarters, and with Rahul coming on board, would be a key focus area, that we carry cash and bank balances which are more than debt. That's where the net debt is negative. So we got to make sure as a management team that we are able to optimally utilize the cash to reduce the borrowings as well. So that's the analysis on the interest cost, wherein there is a 3/4 potential to benefit if the interest rate cycle reverse. On the other income, I would say that what you witnessed in the quarter 4, which is another income of approximately, while it was low. So for the entire year, we had 52 crores as the other income. I think nearly about 50% of that, at least 50% plus, is a recurring income. The balance 50%, about 25 crores or so, came in from the profit from the sale of Milton Keynes assets. So the recurring income is about 25 to 30 crores, year over year.
Understood, sir. All the best, sir.
Thank you.
Thank you. We have our next question from the line of Ravinder G, an individual investor. Please go ahead.
Yeah, overall, the business model looks good with respect to sourcing as a service. So, but the thing is, how do we ensure the quality part? Quality in the sense, like in your industry, there might be some rejections when we are sourcing from other people. How do we ensure the quality? First point. Second point, as we are becoming a larger organization, as the sales grow and the business model kicks, and the industry is also changing, when we take all those points into perspective, so we need large personnel to handle those kind of activities. In the sense, initially, the promoters might be active and they are driving the business to this level. But going forward, we need others also. So how we ensure the human resources point of view. So these are the 2 points.
If you look at the quality rejection side, our quality rejection is 0.0001%. So, we work with the right vendor, right factories, and we have the best quality professionals in our industry working for us. So that's a very small part of our concern. We don't have concern on quality. Plus, if any quality rejection is there, the factory doesn't produce goods to the right quality, normally stays back to the factory, but we have enough, risk management done pre-production stage that we make sure our factories also don't get impacted and also, have very little rejection. So PDS is quite protected from the quality aspect. When it comes to people, PDS is a company built on people. We have the ability to hire the best in class talent. And if we want to, Mr. Sanjay can also, later share, the quality of people who have joined us have left some of the largest, most brand companies in our industry and joined PDS. So our ability to attract best-in-class talent from some of the best companies in the world, because of the culture we have, because of the values on which we operate, and the platform and the incentives we give our teams, we are, finding that as one of our least challenges right now.
Yeah, and
I'm one of the only family member in the company. We are a completely professional run business. So It's a completely 100% professionally run business. With an independent board and a CEO, Sanjay, who's running it as well. Yeah.
And just to add, Palak, one more aspect. I think we've invested into the best talent in terms of experience to take care of the anticipated growth. For example, our head of HR, who joined us about 18 months back, has come from a diverse multinational background. Our head of IT has come from IBM. Our current group CFO was earlier with HDFC Ergo. So all these head of the key functions are now, in fact, already there. We do not anticipate any such additions going forward in terms of the back end of the platform to support the growth of the business. And another important thing to add here is that beyond that point, technology and digital interface need to play a much more active role. I mean, very humbly, we managed 20% growth with negative working capital of 2 days. A lot of that is aided by, yes, a careful selection of FOB business model. But if you see our balance sheet, our inventory days are down, our receivable days are down, our payable days are down as well. So we are using a lot of technology, and working capital is one of the key investments. So we're investing to technology to optimize working capital. We've recently invested into technology in terms of costing tool to enable our fabric and trims expert get a visibility into entire fabric that gets procured across all of our verticals. So this combination of technology, combination of people we've invested into, we believe we are geared up as a platform now to handle more business going forward.
Thank you.
Thank you. We have our next question from the line of Krunal Shah from Enam Investment. Please go ahead.
Yeah. Hello, Sanjay. Hello, Parag. Couple of questions from my side. One is, you mentioned that you plan to invest in manufacturing in India and Egypt. So if you can share the broad capex that you are envisaging for that.
Sanjay, you want to take it first, and I can add?
Yeah. So Egypt, for example, we are in close communication with an existing, manufacturing setup there, fully backward integrated, doing about $100 million of revenue. We believe have potential to bring in marquee customers to them, and therefore able to use their capacities much more better. And there, the partnership is twofold. We anticipate forming a joint venture wherein we would channelize business for them, at the same time take a small equity stake. So strategic cooperation arrangement, a small equity stake. The small equity stake to begin with may not be an investment of more than $1 to $2 million, but the strategic cooperation arrangement allows me to showcase this factory as one of my investee companies. That's on Egypt. In a similar manner, there are opportunities in India wherein the companies have reached on themselves a size and scale of 2 to 500 crore, wherein an association with a group like PDS allows it to be taken to the next level. Therefore, rather than an outright buyout, that is never our belief. We are a company wherein the entrepreneur has a significant minority stake. So in India as well, while Egypt is our first priority because it is our conduit to US, in India, which is the second priority in due course of this year, later part, we do not anticipate anywhere more than about $5 to $8 million of investment to go in there. So all put together, both these investments, India is carefully being assessed, is about $10 million outlay, please.
Sanjay, I just want to add, if you are a standalone manufacturing business, any part of the world, yes, India currently has some, lot of positivity going because of China Plus One and everything. But many of these assets are trading at a deep discount on net asset value and the valuation even 3 to 4 years ago. Mm-hmm. For them to flourish and survive as standalone businesses, like a factory group, even in certain part of India, right, like considering one part of India or in Egypt, it's very difficult for them to have a reach size scale to be able to talk strategically to global customers. Very small percentage of them have the ability to do it. As soon as they become part of the PDS platform, they get access to few hundred customers, they access to working capital limits from our banks, best practice of ESG governance. So PDS doesn't plan to invest in manufacturing into greenfield projects. There are enough good assets created by people in different parts of the world which are actually available to us at a deep discount. And we want to have strategic partnership with those entrepreneurs who are running them. And there's a great value to become part of our group, right? Which is like a 15,000 crore company in the making in the next few quarters, and partner with us in that journey.
Right.
So our strategy is clear. We will have manufacturing assets which are available, become part of the platform, but don't go greenfield from scratch. So like in Egypt, right, we went and analyzed the situation. If we had to put $10 million to set up our own manufacturing, it would have taken us 5 years to break even and maybe reach a revenue of $25-30 million.
Right.
Whereas in this case, asset already exists, doing over 100 million in sales, having very, very strong customers like Decathlon, Levi's, Benetton, already working with them for the last many years, have a huge asset base with vertical integration. So if you have to set up the same setup these people have got, it will have cost us close to $70-80 million to do it. But because of the valuation of the business being low, because of the industry, how a standalone manufacturing business currently in any part of the world is valued, we feel that by putting small investments, taking a small stake to begin with, but with the option to increase it to almost majority, we have the ability to onboard the asset, and become part of the platform, which is a win-win both for that company and for PDS. So just adding to what Mr. Sanjay has mentioned.
Perfect. Thank you so much. The second question is on the lines of sourcing as a service. So what was our sourcing as a service merchandise value that we did for Q4 and also for the full year?
Palak, I'll take that. We did approximately $125 million worth of merchandise value that we handled. So that's approximately 1,000 crore is what we handled out of the total 8,200 crore worth of contract. So that's what we handled. And as we mentioned earlier, we are now targeting it to scale up and come closer to 50% level in the current financial year.
Got it. Perfect. Thank you so much.
Thank you. We have a next question from the line of Vishal Prasad from VP Capital. Please go ahead.
Hi, thank you again. I have a request before I get into the questions. Palak, probably if you guys can plan to have the physical AGM this year, that will be really helpful. That's just a suggestion and a request from my side.
Okay, Mr. Jain will have to plan. Yeah.
AGM. Okay. Well noted, Keshav, your suggestion, please.
Yeah. So next question, and I read your father's book, and it's really wonderful. I mean, there are very few books available in India on entrepreneurs, and the story is very fascinating. So, and there are a lot of literatures available based on your interview. So I got to say, we have, we generally admire Li and Fung, and we have fashioned ourselves on Li and Fung, with basic difference being we focusing on partnership model. Could you talk about the learnings that we have from Li and Fung, especially in the area of risk management, and what have we done to ensure that what happened with them doesn't happen to us for a long period of time?
Just recently, someone spoke to the current second, third generation family member running Li and Fung, the Singh family, and there was PDS's turbocharged, which is what they've been trying to do for the last many years. So they're a 100-year-old company. We are, one-fourth their age. Even we're going to be 25 years next year. But we don't consider Li and Fung as a competitor anymore. Even the customers don't consider us as a competitor for Li and Fung. So when I started the business in Hong Kong almost 5 years back, there were two key differences. Li and Fung was paying people to exit, plus buying businesses on huge valuation, right? So neither did we see any value to pay people to exit, because what you're really acquiring is, relationships and order book. So our idea was clear. Instead of paying people to exit, let's partner with people to grow together. We started getting talent from around our industry, very strong, motivated individuals who wanted to partner and become part of a growth journey. Then people who are, already at the end of their career want to retire and offload their business to someone else. So we started bringing in people and partnering with them rather than paying people to exit. That was the initial journey of how Lianfeng and PDS were very different. One of our board members, Rob Sinclair, was one of the presidents of Lianfeng before as well. And the only reason we brought him on is not to do what Lianfeng is doing, but continue to make sure that we do not fall into the traps that as a company growth falls into. Lianfeng could then become a very hierarchical organization. Once they paid people to exist, then they started bringing president, executive vice president, senior vice president. So this hierarchy of people, how a typical organization grows. We were very clear. We are a platform, neither can be merged, neither can be acquired. Our job is to enable and support an entrepreneur to join us to grow, but govern and control them when it comes to risk and reputation management. So PDS being a value-driven company, if we find any of our entrepreneurs, we have enough checks and balances placed. We've got Navik's whistleblowing website globally, which is sent to all our vendors and internally to all our employees to make sure we report any unethical practices. Find a single issue, we give the exit to our person. We don't care how big, small business they run. So we are a value-driven company, and the reason all these big retailers partner with PDS today because they believe that our governance standards are in line with Fortune 100, S&P 500, and DAX 30 retail companies. So managing risk reputation is center and heart to how we operate, and zero tolerance policy around it. So Lianfeng paying people to exit, we partner with people to grow. Lianfeng after exit creating hierarchical organization, PDS being a platform highly entrepreneurial and agile in nature, with the key differences, how we both evolved in our journey as different organizations. So if you think about as a platform, right, we can onboard 10 talented individuals and not have worry about integration issues. If you see why many companies fail today, right, when they bring in very strong management teams, after 2 years there's politics between people, and then half of them end up leaving or playing 70% politics, 30% doing the job. But because of the organization design of PDS, which is also Harvard Business School case study, we're able to onboard the people, give them a clear roadmap, enable and support them, but govern and control when it comes to risk and reputation management. In PDS, compliance is controlled centrally and cash and treasury is controlled centrally. But the entrepreneur has a free hand to handle all the customer needs based on their own customer portfolio they're managing. I hope it answers your question.
Yeah, sure. So usually when we go with the go and bid for design as a service, so is there a competitive bidding there, or it's generally through negotiations?
Sourcing as a service?
No, a design.
Design-led sourcing, yeah. So on design-led sourcing, which is a vendor model, PDS has been probably the most financially stable player in the industry doing that business. So, financially stable and, having the best design team. So there are some small, medium-sized specialized players who are competing, but, customers today not only are buying product, they're buying governance, they're buying financial stability, they're buying a global vendor base, right product, right country, right factory. So yes, there will always be small, 50, 100, 200 crore companies competing against us. But more and more we are finding them disappearing and, customers trying to work with more structured players, which not too many exist in the world.
So it's more relationship driven or strength driven rather than bidding?
No, yes, completely relationship driven. When I say, in technology, the enabler in the industry, not just disruptor. Even if I look at Amazon, most sophisticated, buying organization, buying apparel, they still have individuals who are running their sourcing. And the individuals will place business to companies based on the trust, transparency they have with the vendor base. Even a company like Amazon is not doing digitized or, let's say, online bidding to procure products. So the advantage of the industry is that if you see the garments, right, if you go to stores, there are thousands and thousands of new options coming every month. So, it's a design product, it's a bit touchy-feely product, so their relationship and, it's art and science. So art is very important along with science. So maybe some very core volume line they try to, do bidding, but I would say that's a small part of the business.
And just at one point to add to what Palak was saying, when we walk into the room, it's not just about design or commercials or governance, but the fact that PDS has been carefully building a venture tech investment portfolio, wherein we spot, we nurture some newest processes, technologies, which are aimed at improving the carbon footprint, or preventing the garments in terms of getting into landfill. So to all the large retail customers, such commitment to the environment, such commitment to sustainability, circularity becomes a big important factor for them to consider PDS as a counterparty to the business.
So PDS is a platform, a venture arm of the ecosystem. The ecosystem is driving innovation both to the platform but to our customer base as well. For example, Walmart, one of the key initiatives was to do onshoring manufacturing in the US, plus also become under sustainability. So one of PDS venture investments is fitting perfectly into their goal. And because of that, we have a meeting with one of the presidents of, Walmart Global Sourcing in US, because they see the innovation PDS is bringing, right? So big organizations rather work and partner with companies which is bringing them innovation and partnering with them on this today's journey, rather than just being a supplier sitting in one part of Asia trying to do, design and supplying them apparel. So today, if you're not part of the ecosystem, if you're not part of a platform, a standalone business unit in any part of the world has very limited future. So PDS has organically created this, in the last 20, 25 years. And as I said before starting the call, the pipeline of opportunity we see now coming is more than we've ever seen in the last, many years of our existence. So my last point would be if people are going to look at PDS on a quarterly basis and make a decision, probably there are better other companies you guys can invest in. So if you believe in the next 50-year journey, PDS is going to become one of the largest companies in our industry and a force that every retailer today wants to partner with. So someone needs to have a bit of a vision and a mid-term goal plan to become part of this journey if they really want to be invested in our business.
Yeah. So we have got BGS on our board, and BGS, given his background in Infosys, and he used to head retail there, he will be having a lot of CXO level relationships with a lot of retailers in the US and Europe. So is there a thought process behind bringing him on board that he will help us in getting some of the customers?
That is definitely currently we've not even discussed it, but Sanjay, also we can mention that with Bain Consulting, Alex Partners, some of the BCG, some of the top global consulting firms, we are being approached by big retailers for strategy and restructuring. And, for them, PDS has become one of the partners. So, Bain is closely discussing, working with PDS. They have a kickoff meeting soon, where they're also saying they don't want to, have any upfront fee with us, but align with our next 3 to 5 year objective and partner with us in that journey. And, a lot of referrals are coming to the global top 4 consulting firms as well. So I think reaching the right clients, is not a big issue for us. It's basically, managing our own growth based on our own internal cash flows, making sure that we are not taking any inventory risk, not taking any credit risk is a key factor, limiting factor we have currently in PDS.
Yeah,
and all these venture companies, getting this, big $50 million, $100 million checks and go and spend it and see what happens after the next 5 years. PDS, we basically reinvest our own profit into growth. And, we do it in a very cautious manner, making sure we don't take any inventory risk or credit risk. So that's the only limiting factor we've got. We are saying in the company that, whatever profit we make, we are investing. And we're not taking any debt. Company has no long-term debt. Long-term debt equity ratio is almost zero. And, we're not tapping capital markets for further expansion.
Thank you. Ladies and gentlemen, that was the last question for today. I would now like to hand the conference over to management for closing comments. Over to you.
Thank you so much, Nuama, for organizing this. Thank you to all the listeners who joined the call, and a good weekend ahead, and stay safe, all of you. Thank you so much.
Thank you. Thank you, everyone.
On behalf of PDS Limited, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.